Capital gain taxes are increasing dramatically. In this episode, I'm going to address the question, what constitutes a capital gain? Get ready, because you may not even be aware that you will be paying a capital gain tax maybe sooner than later, and I want to empower you on what you should do to avoid unnecessary tax. So my name's Doug Andrew, and I've helped many thousands of people save unnecessary tax, minimize taxes oftentimes, and optimize their assets so they don't outlive their money later in life during retirement. Because I find it so sad when people save, they work hard throughout their lifetime, and they think they've done a pretty good job saving, and they may have a $500,000 nest egg, maybe $1 million, maybe $5 million, $10 million. And then about 15 or 20 years after retiring, they are concerned because they're going to outlive their money, and they go, I never saw this coming. So let's talk about capital gain taxes, because as of the recording of this episode, we are early in the Joe Biden administration. And if you're aware, he has had a lot of proposals where he is spending and plans to spend about triple to quadruple what the IRS actually collects in taxes. In other words, that's called their income. Now, if you spent 3 or 4 times what you made in income, what would happen eventually? But the government seems to get away with this. And so taxes are going up dramatically, income taxes, especially on the high income earners, but the hidden tax that they don't talk about is inflation, because that affects everybody, even the little guy, when the government prints money and what have you. But one of the biggest tax increases to individuals that the Biden administration wants to change, and this happens oft times when we have government revenuers who love to spend, they change the capital gain tax from a lower rate to ordinary income rates. Now, why do they do that? First of all, to understand why they do that, let's define what a capital gain is. When you have an asset that appreciates in value, it could be stocks, or oftentimes it's a piece of real estate. So let's say you or your folks bought a single resident home 30 years ago for $250,000, and they started renting it out. So what happens when you rent out properties? You usually write off the maintenance and repairs, the interest on any mortgage you have on that, and also you depreciate it. So you're depreciating it down over 27, 30 years to where it just gets down to the value of the land. So as you depreciate the property down, what happens to most properties? They increase in value. So in 15 years, very often that $250,000 single resident home is now doubled to $500,000. And then in another 15 years, it's doubled to $1 million. So now you have a 5-bedroom home, and this has happened in California. There are 5-bedroom homes in the San Francisco Bay Area that are worth $4.8 million. And they were built for $230,000 years ago because California has been crazy. But in most places in America, let's say that the appreciation rate has been about 5% a year. That means the value will double about every 15 years, to be precise, 14.4. So here you have this rental property, and now it's been depreciated down, and it's worth $1 million, and you sell it. Well, that is called a long-term capital gain. Usually long-term means you hold on to it for 12 months or longer. Sometimes the government says, well, 18 months or longer, because short-term capital gains, if you buy things and flip them, that's a short-term capital gain. If you don't hold on to it for 12 months, maybe 18 months in some periods of time when Congress has allowed that. And you have to pay ordinary income tax. You're just like earning it as a wage or a salary. And so that tops out at around 37 to 39.6% right now, because when you sell a highly appreciated asset, that capital gain is added to your ordinary income to calculate the rate that you pay. Generally speaking, this is not a political agenda here. Generally speaking, Republican administrations, a Republican Congress will usually have a lower tax rate for capital gains because it's sort of an unfair tax. Why is it unfair? It's because when you look at property appreciating from $250,000 to $500,000 to $1 million over 30 years, usually 40 to 60% of that appreciation was just inflation. It was the cost of living going up. So it's unfair to tax people for inflation, especially when the government caused the inflation oftentimes. And so that's why Republicans usually say, no, the highest capital gain tax you'll pay, for example, under the Trump administration was 20%. I know because I sold a highly appreciated commercial building. That was added to my income and it topped me out and I had to pay 20%. Because of Obamacare, you have to pay another 2.7%. And then the state you live in will probably charge a capital gain. So I had to pay, like 27 or 28% in capital gain tax. When tax revenuers are looking for more tax revenue, they will sometimes say, well, we're going to change the capital gain tax to ordinary income, whether it's short-term or long-term. That's what the Biden administration has announced. They want to go up to the ordinary income rates. So if you inherited a piece of property from your folks, or you sell a highly appreciated asset, you'll likely be paying the highest tax rate if it's a large asset. That would be nearly 40%, plus the state, plus the Obamacare. They're going to take half of that. Now, how have people avoided that in the past? Many times, in order to avoid paying a capital gain tax, people have used a section of the Internal Revenue Code called Section 1031. That allows you to sell a highly appreciated property, let's say, and then buy a like property of equal or greater value, and you get to continue to defer paying a capital gain tax. That's called a 1031 exchange. Well, oftentimes people do that, and they're really sick and tired of being a landlord, taking out the trash, evicting tenants, and fixing toilets, but they're stuck because if they sell it, they're going to have to pay this capital gain. Nobody likes to pay tax, and so they think they're saving by putting it off. Well, that looks like it might be going away. See, because they continue to do 1031 exchanges, oftentimes inheriting new headaches with a new property, going from the frying pan into the fire, so to speak. But they're doing it so that when they finally die, they can leave it to their children. Because when you leave behind something to your children as an inheritance, most of the time, children get a step up in basis. Meaning, in that example, a property that your parents bought for $250,000 and now it's worth $1 million, when they die, you only have to pay a capital gain tax on what you sell it for over and above $1 million. You got a step up in basis, whereas your folks, if they would have sold it, they would have had to pay a huge capital gain. Biden wants to get rid of that step up in basis. Wow, that means you inherit that. Unless you live in it as your primary resident, in most states, what's going to happen is you're going to have to pay federal and a state capital gain tax. And he wants to take that up to the 40% from 20%. And he wants to do away with the step up in basis. Let me just cut to the chase. On this example, if you inherited a rental property for $1 million, and you waited a year and sold it for $1,100,000. Under the Trump tax laws, you would have paid a 20% federal tax on the last $100,000 that you sold it for over and above what it was worth when you inherited it. Under Biden's plan, it appears like you would have to pay a tax of up to 40% federally on the entire $1 million gain. I'm subtracting out $100,000, the value of the property or whatever. That's a difference of $20,000 versus $400,000. Why do they do this? Because they love to tax when money flows to the next generation because they didn't really earn it. And that's what's about to happen. So what can you do to save yourself unnecessary tax? So I want to gift you a free copy of my most recent best-selling book so you can gain some insights into opportunities that maybe you didn't know existed before. But let me connect the dots. Many times people keep putting off and deferring and doing 1031 exchanges even though they don't like being a landlord anymore. And there's actually stories in my book that talk about this. They hold on to it thinking their children will inherit this and get a step up in basis. I can think of a guy, he did 1031 exchanges, and when he was 76 years old, he had a stroke and he turned it over to a property manager. And while he was in this convalescent care center, they embezzled $750,000. And so just ugly, ugly stories. But I said, you know what? you've got these two properties, sell. And I showed him selling these two apartment complexes. One was over 80 or 90 units, the other was 76 units. And take the $4.5 million. And I showed him by putting it into a portfolio of laser funds, he could easily generate about $400,000 a year of tax-free cash flow with the equity that he got out of selling those properties after paying the capital gain. He goes, I don't want to pay the capital gain. But he goes, that's more money than I'm getting net after tax on my rental income. I don't have to fix toilets and evict tenants anymore. I go, no, what am I going to do with my time? Why don't you relax, you know? But he saw the wisdom. And he was flabbergasted because I was saying, get rid of the capital gain tax when it's only 20%. Don't wait around until it goes to 40 and the step up in basis is done away, because then it's not going to help your kids. Because do you know what he said? He goes, well, this is my kid's inheritance. I brought all of his 6 children into the office and I said, I want you to shoot straight with your father. What are you going to do with these 2 big apartment complexes when he passes away? And they looked at their dad and said, Dad, we don't want to offend you, but we hate these apartments. On the way home from the funeral, we're putting up the for sale signs. He finally got it. The children opted to have him sell it. He put it into a portfolio of laser funds. It's generating over $400,000 a year of tax-free income for the rest of his life. And when he dies, the laser fund blossoms to $6 million. When I asked them, would you like $6 million 3 weeks after your father passes away tax-free? Or would you rather have $4 million of apartment complexes that you hopefully can then sell and get your money out of them? They said, we'll take the $6 million tax-free 3 weeks after Dad's gone. A lot of times people don't think. If you want a free copy of this book, you'll gain insights. There's 12 chapters on the backside. This is actually 2 books in one. And one of them talks about real estate opportunities and when you should pay a capital gain tax, maybe sooner than later, instead of paying double. Go to laserfund.com, click on the link below, contribute a nominal amount towards the shipping and handling. I'll fire out a copy of this book. There's other opportunities also there to listen and learn, watch and learn. And also, you can be on our list to be notified when we teach in-depth educational webinars, which we do on a regular basis in order to show you opportunities that maybe you didn't know existed before. So here's to your brighter future.